Thank you, Dean Alexander. I'm really honored to introduce the panels today and humbled to follow in Mike's footsteps. So thanks everybody for being here. I swear some of you are in the same seats you were in last year. I think everybody took the exact same seats. So I think we're trying to make sure we're still good online. But just to give you an idea, we're going to have 150 plus people in the room, 250 to 300 online. We have press. We have representatives in person and online from at least 12 departments of revenue. So we really have a great mix, and that's the whole point here, is to get practitioners, both attorneys, accountants, in-house professionals, professional organizations, as well as government and our judge panel. So it's going to be a fantastic day. I literally stand between you and the first panel. So you're going to see enough of me today. I'm going to turn it over to our first adjunct to introduce the panel and take things over, Tom Donnelly from Comcast.
Thank you, Drew. Good morning, Jeff.
Good morning, Tom.
Jeff is a partner with Eversheds Sutherland, a longtime friend, and for Comcast, our primary outside counsel, not exclusive, but primary. And Professor Pomp, who, University of Connecticut, NYU Law School, but I know Professor Pomp as a very valuable asset to us as an expert witness in much of the litigation that we do. He's a master at taking judges who may not know or feel uncomfortable with state tax and making them feel even more uncomfortable. So
now we're all uncomfortable collectively. Okay. Good morning, guys. Privileged to be here. We very much miss Mike. Tom just finished his 30th year. He doesn't want to tell anybody, but I'll embarrass him. 30th year at Comcast, and it's been an honor to work with Tom for a few decades. Professor Pomp's been teaching at NYU since 1986, correct?
Yep.
And it's an honor to be asked to be his co-professor several years ago. So two of my closest, not just state tax colleagues, but personal friends, and it's an honor to be here today. We have a fun topic, apportionment topic. I feel so uncomfortable sitting here talking right now. I like to stand when I talk, as you guys know, but I'm going to do my best for a minute. One-legged stool, we're going to be sharing some observations regarding some recent cases on apportionment and some also law changes and regulations as well, if we have time. As you guys know, my colleagues here have very strong opinions about things, and I suspect we'll have some fun debate. Professor Pomp, anything you wanted to acknowledge on the front end?
I want to start with the railroads, if you're ready.
Railroads. I took the railroad here this morning, so I'd love to hear about it. Let's hear about railroads.
The railroads were such a transformative, had such a transformative impact on this country. They're kind of like the internet in my mind in terms of how they just revolutionized what we did. And they had an enormous impact on the legal system and on apportionment. Let's just talk a little bit about the railroads because there's some, perhaps, comparisons that can be drawn. These were the robber barons, you might remember. These were people who accumulated enormous wealth in an era when they were free of any regulatory constraints. There were no statutory constraints. They indulged in what many people would describe as illegal practices under today's standards, unethical practices. And just think about it, no estate tax. So this wealth went untaxed. Later in life, we get a progressive income tax in, which keeps new wealth from really being accumulated and in a way protects existing wealth. So it's just amazing. Now, a lot of positive contributions of the railroads, but you know, the Indians didn't think so and the Chinese didn't think so. So it was sort of a mixed bag. Legally, if you remember your torts class, so many of the early torts decisions were because of the railroads. They had a way of just killing people on the tracks and killing animals and starting fires with their embers. And they also started us down the apportionment path. Little unsung heroes 1884, Jeff and I teach this case, Union Pacific. It involved a property tax. How do you apportion a property tax on a railroad that has all of this property throughout the country, movable property passing through your state, tracks, of course, terminals, and the Supreme Court allowed a state to apportion the property tax by track. So the base of the tax was the property owned by the railroads everywhere. The state share of it was their percentage of the track. In their state, in the numerator, track everywhere in the denominator. Sounds familiar? Next case that comes up is the Underwood typewriter case. Typewriter company based in Connecticut, manufactures. Connecticut used to be a manufacturing hub. Hard to believe even cars were made in Connecticut in those days. And Connecticut was faced with how do you deal with a multi-jurisdictional corporation? And they used a single factor, that part sounds familiar, property formula. That part's not familiar. It was a revenue maximizing formula when you think about it. The country develops East Coast to the west, and if you're a state and you're figuring out what's a good apportionment formula, you have a manufacturing enterprise, it sells throughout the country, you want a property factor. It's better than diluting your apportionment with a sales factor. Most of the sales are taking place outside the state. Single factor property. U.S. Supreme Court in a famous Brandeis opinion says, you know, it's almost impossible to apportion the income under these circumstances. This is, you know, for all we know, this is as good as it's going to get, nothing in the record. And without much discussion about maybe an apportioned property tax is very different from an apportioned income tax, the court marches us down the road of apportionment. We didn't have any sophisticated learning on transfer pricing. No one really said, well, maybe we should use separate accounting for this situation. It wasn't part of our mindset or our vocabulary. Next case comes up, Bass Ale. You might remember, brewery based in England, sells throughout the U.S., single factor apportionment by New York, property factor. Next case, Hans Rees, more familiar perhaps to many of us, a tannery, operations throughout the country, tannery located in Asheville, North Carolina. North Carolina applies a single factor property formula. Revenue maximizing. Then we roll the clock forward and we get the Uniform Division of Income for Tax Purposes Act, brought to us by the Uniform Law Commissioners, and they adopt an evenly weighted three-factor formula. It had been used in the country. Massachusetts was one of the practitioners of this, other states also. And if you're the Uniform Law Commission, you want to propose something that's going to be attractive to all the states, because the last thing you want to do is propose a uniform law and no one adopts it. And so when you think about UDITPA, evenly weighted three-factor formula, we have origin-based factors, property and payroll. We have market-based factor, sales. Everyone had a chance to share the pot. And so that became the dominant form. Fast forward a little bit. The problem with the three-factor formula with property and payroll, as people became sensitive to, it discourages corporations from moving into our state because they're going to be hit with a higher property factor and a higher payroll factor. And the state said, well, this may be discouraging business location and may be discouraging businesses from expanding in our state. Let's put more of a weight on the sales factor. So now if you're based in the state and you're selling outside the state, you're going to double weight the sales factor, which gives you a reduced tax compared to a single factor. And if you like double weighting so much, let's go to infinite weighting. And that is only a sales factor. And indeed, the country has marched in the direction of only a sales factor. Jeff?
Great overview, Professor Pomp, and it's with that backdrop. We have a bunch of slides that kind of set up the issues that Professor Pomp was describing, what led us to the single sales factor. And if you think about it, fast forward today to the map. I can't see it behind me. There you go, Tom. You can flip the film strip for me.
Yeah.
Oh, I can walk around?
Yeah, go ahead.
Oh, good. So liberating. Thank you, Drew.
So before we jump into this,
Yeah, tell me.
I wanted to take a few comments on the one-legged stool.
Okay,
All
that
right,
was
so
my
I'm not going to let him get
title.
off the title slide.
Okay, be kind.
Is it really that bad? And if it is bad, and this is more of a multiple choice question for Rick and for you.
Yeah.
So what's the root cause of a lot of these issues? Is it the change in the economy, the change in supply chains, the morphing of products, services, and intangibles, all of the above, state administrators being overly aggressive?
Yeah, let me give my view. I am a little bit uneasy because I know there's press in the room and on the phone. So I'm going to say I'm not talking on behalf of Comcast or any other client when I answer your probing questions, Tom. My view is that if you think about today, there's the map. Single sales factor is dominating. It's green on the slide. At least I have trouble with colors, but I think it's green on the slide here. Most of the population is under single sales factor. California, New York, Illinois, Texas, et cetera, New Jersey, single sales factor states. It's dominating. And the reason why I think of it as a one-legged stool is that there's so much pressure on the single sales factor to do its job, to get it right. And let's talk a little bit about that as we go here. Is what is the job of an apportionment formula, and how do we know when it's doing its job and getting it right? There's so much pressure on both the numerator and the denominator. There's so much opportunity for it to go wrong that I do wonder if the one-legged stool is the appropriate way to apportion a single sales factor versus a three-factor formula.
Well, we'll get, Rick, what do you?
I think it's an abomination. That there's been nothing worse for the integrity of the state corporate income tax than the march toward a single sales factor. 1935, just to answer your question, Moorman, Supreme Court case, accepted Iowa's use of a single sales factor. Why Iowa, of all states? Maytag and John Deere tractor, located in Iowa. 1935, depth of the Depression, governor has to do something, goes to Maytag and John Deere, the two major employers in Iowa, and says, look, got to do something. What can you folks live with? Oh, Governor, we're good corporate citizens. We'll go along with a corporate income tax, absolutely. We play ball. The only thing we ask is that the apportionment formula, governor says, say what? Well, don't worry, Governor. The apportionment formula should be just a sales factor. Well, of course, they didn't pay much under that. You know, a bunch of hypocrites like usual, and that's the start of it. No one today thinks using only sales and disregarding capital and labor gives you a better measure of income. It doesn't, and there's no state that moved to a single factor on the grounds gives you a better measure. No, it's all economic development, Tom.
It's a tax incentive. It's a tax
It's a tax incentive.
Right?
Yes.
Yeah, and before we had a single sales factor, the incentive industry was cutting special deals for potential new entrants into their state.
There's a couple cases I think we should talk about that highlights this. Maybe you can advance us here, Tom. We'll talk about a few cases and revisit how the one-legged stool is not doing its job. I know there's a delay. You have to hit it like 5 minutes in advance, I think, and then you'll get your slide. We can start talking about it, though, beforehand. I don't know if there was a case that you wanted to jump in on, Professor Pomp. I'm going to get us started, if that's okay with you.
Good.
We've seen a bunch
eventually Smithfield, so.
Okay, well, I can't talk about it, but you
But
can.
I can.
Yeah.
And you could just smile.
I'll smile anyway. Microsoft is litigating a number of cases around the United States. We're starting to see the decisions. California Office of Tax Appeals issued one. And this case, I'm involved in this case, so I should disclose that. In this case is likely to be appealed, but it has not been appealed yet. So I guess I should be careful since there's press on the call. It has not been appealed yet, but who knows what will happen. Okay. Microsoft challenged the 965 pickup and how the apportionment factor should be computed. I'll just give a little bit of facts, Tom, and I want to hear your reaction to it. So if you recall when we had TCJA, the federal tax changes created a situation where there was this buildup of income outside of the United States back to, let's say, 1986, about the time that you started at NYU. It's just a coincidence. And as a result of this federal tax law change, some international companies or multinational companies repatriated, meaning brought in income that was earned outside of the U.S., they brought it into the U.S., either literally via a dividend or through a deemed dividend where they reported it but didn't necessarily bring the cash back. The question is, when you have that pickup of foreign income into a U.S. tax return, which then gets reflected on your state tax returns, how do you compute your apportionment formula? And when you're looking at a single sales factor, how do you compute the sales factor specifically? So Microsoft was of the view that, one, there should be reflection in the apportionment formula that relates to that foreign income. There's no question, guys, that that income was foreign income. The only question is, how do you compute the formula to reflect the fact that it's foreign income? And this is where the dispute started. Oregon, I think, took an outrageous position. I thought it was outrageous that the apportionment formula should not reflect at all the foreign income. So you should use just your U.S. domestic apportionment calculation without taking into account the fact that this income had no connection at all to the U.S.
Now, real
it was
quick,
earned outside of the
there's
U.S.
precedent for that. Other bad decisions in other states where dividends just don't get any factor representation.
And what do you think about that?
Oh, it's horrible.
Horrible.
Yeah.
Professor Pomp, what do you think about that?
Well, it violates a number of basic principles. If income is entering into the tax base, if gross receipts are entering into the tax base, the gross receipts factor, sales factor, gross receipts factor, has to match the gross receipts that enter into the tax base. That's the whole idea of apportionment. And if you're going to treat the foreign dividends as apportionable business income, which I think they did because it went into the tax base, right? And we're in a world of apportionment now, then the sales factor has to match the gross receipts that enter into the tax base. And so I think that you should have been looking at 100% and not 20%. So, you know, if I sell something, break even or loss, what goes into the tax base? Well, initially, $100 of gross receipts. Then you give me my cost of goods sold, $100. Oh, zero. But what goes into the sales factor is $100 of gross receipts, not zero. So I think it was a mismatch.
Ricky, you saying that the $100 dividend should have gone into the gross receipts?
Let me give a little bit of
Absolutely.
context to that before you guys get embroiled in this. And that is that, and this is the same issue that was litigated in California, by the way, which is still kind of ongoing as well. And that issue is as follows. When a state says, we're going to tax your foreign dividend income, but we're going to give you a partial dividend, let's say 80% dividend. That means 20% of the income is going to be included in the tax base. Great. What gets included in the sales factor? Is it zero? That's what Oregon said. Is it the 20% that's included in the tax base? Or is it 100% of the pre-dividend received deduction amount, the entire dividend? Does that get included in tax base?
Well,
and this is where practitioners are debating.
And you might, and Microsoft,
which one?
Let's
Yeah.
say there's a $100 dividend.
Yeah.
And the taxpayer had $1,000 of receipts to generate that $100 of profit.
Okay.
So there's a 20% pickup under the Oregon rules.
80% dividends received
Right,
deduction.
and the tax court ruled, 20%, $20 goes into your denominator.
Mm-hmm.
Whereas if this had been filed on a worldwide basis and an apportionment calculated on a worldwide basis, you would have had $1,000 in the denominator, not 20. And that would seem to be the better. And now when you deal with 965, which picks up 20, 30 years of accumulated profits, why aren't the 1,000 times 20, adjust for inflation, why isn't that in the denominator?
And then in this specific case, the one in Oregon that we're talking about, this was that one-time event where you go back all those years because it's the catch-up year. That was what was litigated in this Microsoft Oregon case. That adds another layer of complexity when you have this buildup of income over a long period of time.
Now, we blew past it on the slide deck, but I wanted to ask on Section 18, where, this is,
Let's get there.
For distortion.
Yeah, let's get
I
there.
wanted to ask you what's distortion? What's the definition of distortion?
Yeah, let's have
Because I
that.
think that's the tough.
Let's have that debate.
I think it's sort of like the Supreme Court in pornography. Like, there's not really a clear definition, but you know it when you see it.
I know it when I see it. Rick, how about you?
Yeah. Pornography? I lost the train here.
All right, let's go to the next slide, maybe. I want to get out of this ditch. Okay. This case, there was some news on this case, Rick. I know that you have some thoughts on this one as well. This has a combination of unitary and apportionment all in one case. And the Virginia Supreme Court just a day or two ago denied review of this case. So here we go. We have a company, a corporation that owns a partnership interest. The partnership interest operates those rest stops all throughout the United States where truckers stop and get gas, and they have stores and that kind of stuff. Pilot, I think. Yeah, Pilot. And the corporation that owned the partnership interest was also in the fuel business and actually sold fuel to those Pilot stores, which I found really interesting. Anywho, the lower court determined that there was no unitary relationship between the corporation and the partnership that it owned a part of, which I thought was super interesting in its own right. And then the next question is, since there's no unitary relationship between the two, how does the corporation reflect the income and apportionment factors in the partnership that it owned in its Virginia tax return?
I will take that.
Well, go ahead.
I mean, the case is important for what it says under Virginia law, what the indicia of a combined report unitary business consists of. And it was pretty orthodox in that sense. It talked about centralized management, the lack of economies of scale, the lack of, what am I missing?
Economies of scale, functional integration.
And functional
centralized
integration.
management.
That none of this existed. And therefore, these corporations or partnerships should be viewed as if they were strangers in the eyes of the law. And so nothing has to do with the factors flowing up or anything else because they're not being combined. They're just two separate entities.
So can Virginia tax the partnership income earned by that corporation?
Well, under their existing statute, I would say no. That it should be allocable and not apportioned.
Allocable is the...
Right. And then the question is, well, what's the rules on allocation?
Where to allocate it to?
Yeah. But I don't think it's Virginia, so.
Well, for me, there's two ways to... We have sparred over this over the years.
Yes.
We have a partnership. It flows through. We're non-unitary with the operations of the partnership. And allocable for us typically means we calculate apportionment for the allocable income based upon the partnership's factors and then just use that to spread it. We don't try to push it to one place like a commercial domicile theory.
Let me just put a little finer point on that, Tom. So if the partnership down below, you're the corporation, you own a partnership, you're saying I don't have a unitary relationship with that partnership, but that partnership has, let's say, Virginia operations in it, so it has Virginia apportionment. Would you include in Comcast's, tax return some of that income because the partnership itself had Virginia apportionment factors in your Virginia return?
On the post-apportionment line, yes.
You would.
We would not put it into the apportionment calc.
Some of my clients would not.
Right. Now, I have a question for you and for Rick, which is, this is one partnership, one flow-through. What happens when you have two 10, 20. At some point, are you, is that a portfolio that?
You're asking the question, at some point, do you become in the business of owning non-unitary
Exactly.
partnership interests?
Exactly. Exactly.
That'd be a great exam question, Professor Pomp.
Well, now, are you a conglomerate? Or are you more of a hedge fund? Or what are you?
That's a good question. I think that's what I'm asking you.
Yeah. Well, we did talk about this for Berkshire Hathaway once upon a time, and we talked about this for GE once upon a time.
Yeah.
And we decided, based on the facts that then existed, that this was really a conglomerate and that there was no unitary relationship between the parent and any of the subsidiaries or any of the related entities, and they should be treated as standalone. Whether that would still be true today, I don't know. But
As a practical matter, I can tell you that our experience is when the allocation, using the method that I described,
Yeah.
results in some income or a good slug of income going to the state that's auditing you, they're happy, they're fine.
right.
It's the states where the partnership the flow-through entity, I should say, didn't have any ops, and so they're
partner
getting a
did.
donut.
Yeah.
Then all of a sudden, they start making imaginative arguments like, are we in the business of?
Right.
So,
Now, I'm going to move us along because it's going to next two cases, one's going to touch on your Section 18 point, Tom, and then the next one's going to come back to the single sales factor debate in Massachusetts. But let's talk about the Jeffries case. I know there's somebody in the room that was involved in this case. I'm not going to make eye contact with him because I don't know if he wants to talk about it, but we're going to be very kind to your case, Bill. Jeffries litigated this case in New York. I'm going to boil it down. This is a very I think it's a painful case to read. I hate the way they write their decisions in New York. It's numbered paragraphs that goes on for, 100 pages. It's really difficult to parse, but I'm going to boil it down, guys. First of all, whether whether the sales factor should be computed on a look-through basis or not. Let's talk a little bit about that in a second. And then secondly, let's look at the result to determine whether alternative apportionment should apply or not. But the first question's first. When you have one New York financial institution providing services, earning income from other New York-based financial institutions, does that mean, and those financial institutions have investors all over the United States, maybe all over the world, should all of that income or most of that income be cited to New York because the headquarters of your customer is in New York? That's one of the questions that we're kind of struggling with throughout the United States.
I think that's a common theme through a lot of these slides, and it's a common issue that we're finding, which is it's really difficult sometimes to define who's the customer. Where do you stop the music for the distribution channel that you're using? Because obviously the end use, there's no one debating that the end beneficiary of all these services is the retail customer, so to speak, across the nation. But, that doesn't get New York a great answer, so they prefer to basically use the intermediaries, which you're looking at contract privity, basically, right? You're
Yep.
saying you have privity of contract here.
Or where the service is being delivered, or where the benefit is
But
received.
no, you have
of the
contract
service.
privity, and that's what I think they're looking to and saying that's what should drive the receipt. Other states, you will see in other slides, other cases, ignore contract privity and simply say we want to understand where the product or service is ultimately used, viewed, et cetera.
Professor Pomp, do you have views on this look-through question?
Oh, sure.
Different than your
Let's
views
simplify
on
the facts
distortion?
because it's very complicated.
It is complicated.
But Jeffries is a global investment banking firm. One of its clients is Vanguard. Vanguard has mutual funds. So we are the retail customer of Vanguard, and Vanguard is the customer of Jeffries. And Jeffries, I'll just give you some of its income from the case, executing brokerage transactions, margin, interest, clearing fees, and they get paid by Vanguard for performing this. Vanguard wanted, or what?
Fund.
By
The
the Vanguard
Vanguard
fund.
Fund. Vanguard never pays the brokerage firm. There isn't any institutional intermediary that bears the expenses of their clients.
Yeah, did I
Right,
not
Jeff?
say that?
Bill Luna from Jeffries, are here, everybody.
That No, I think well, if I didn't say it, Vanguard pays Jeffries.
Funds pay Jeffries.
Well, when you say Vanguard's funds pay it,
Right, and those funds have investors in them. correct?
The investors bear the cost.
Yeah. So the question is, where do you cite as the revenue that
Yes.
Jeffries is earning?
How far down the chain do you go? And what information does Jeffries have that would allow it to go to the lowest retail
Should it
level?
matter? Let's assume that Jeffries has perfect information and they know how far down they can look. They can look through Vanguard. Sorry, Bill, I'm going to be a little general here. They can look through Vanguard and know where Vanguard's investors are located. Should that matter?
Well, even if they could, it doesn't necessarily matter if you think that
I agree.
the customer of Jeffries is not me in my mutual fund. But it's worse here because what do you use? They don't know about me. They don't have any mailing address for me. And part of what the court was struggling with, well, do we use census data if we go down that path? And ultimately, on appeal, the court really sided with the state, didn't they?
On appeal.
On
yeah,
appeal.
You guys won a trial, but on appeal we got reversed. And is a bit.
Won 2 of the 3 issues.
Yeah.
Plus the receipt.
And you had the investment capital,
appeal.
which is, yeah, right.
What's the status of the case, Bill, right now?
Right now, it is, if we were filing an Article 78, which we're not disclosing whether we are or not, that is due June 20th, 4 months
Okay.
after the decision.
Okay, so we'll know by June 20th or June 21st. Okay.
The one thing that's not really focused on is that New York has a very specific statute.
Yes.
It says customer in your books and records responsible for paying. Okay, once you put the words responsible for paying, then Professor Pomp is the customer for that purpose because he's the one who's bearing the expense of that trade through his pickup of dividend or short-term or capital gains.
And should it not be paid? Do they come after me?
No, we can't. No,
I thought I was
we-
responsible.
You're responsible for paying, but it's through your ownership of the shares. The fund is paying it.
Yeah,
at the end of
so,
the day,
so
but
in the
you bear
management
those
fee,
expenses.
so in the management fee that I pay Vanguard,
All right, Nick.
Bill, oh,
Yeah.
So I don't want to rile up your client. But responsible to pay assumes privity of contract. There's no legal obligation.
there's
for
no
the client to
privity
pay.
with me.
There's no privity with Rick.
All right, so it's going to be an interesting case on appeal. And Tom, where's that clicker? You're going to hit it. We're going to go to the next case.
One more,
Come on.
Rick, is the privity of contract standard at least then gives you better information than making assumptions when you go beyond the person that you have privity with?
Yeah, I know that you're all worked up about this privity of contract thing, and sometimes it makes sense, and sometimes I don't think it makes sense. We can debate it.
The tension between economic realities and sort of the legal structure.
I think that when we have to wrestle with whether you look through your customer to go to your customer's customer, that's kind of what we're talking about here, guys.
Exactly.
You have to look at the underlying statute and look at how, as Bill was saying, what is the statutory requirement? And we have so much so many sets of different rules right now. Sometimes it's benefit received. Sometimes it's an industry-specific rule, like Bill's facing in New York. Sometimes where the service is delivered. If it's where the service is delivered, Tom, does it matter where the privity of contract exists or not? So if you and I are entering into a contract together, I'm providing services to you. You, in turn, are providing the services I'm providing to you to another customer, and the service is being delivered to a different state. And I don't have any privity of contract with your customer. I just have privity of contract with you. Should it matter?
And this, it does. Yeah, it does.
Okay, we can debate
our
that.
circumstances are content producer sells to Comcast as a cable distributor. That handoff occurs in Colorado. They run fiber to Colorado. Should the sale go to Colorado from the content producer, and then Comcast simply picks it up? Because that receipt from the cable bill.
No,
that
keep going.
that receipt from the cable bill
Next
is being
step,
paid by the
we just
customer.
shut the microphone, that's all.
That's the next step. Yeah. Working on it. Working on
I
it.
think it matters. Everybody has different circumstances.
Yes,
If my
thank you.
my head end was getting, if our head end was in Pennsylvania, I think I'd be flipping on a dime saying, absolutely, look all the way through. But it's not.
So do you wear Skechers, Tom? You'll never believe this, but some people have Skechers, some people don't. And Skechers had this really interesting case in Massachusetts. Before we get into the legal analysis, let's just talk about what Skechers did. What Skechers did, I think this is common practice now, is that they design the shoes, but they don't make the shoes.
Right.
They enter into contracts with third-party manufacturers who actually make the shoes. Massachusetts has, in my view, a horrible rule, and other states do too, which is that they're going to make, and it's actually now been changed, the statute's been changed, but at the time of this case, Massachusetts required manufacturers to use single sales factor, non-manufacturers, 3-factor, let's say. So the question is Skechers a manufacturer or not? And Skechers had an interesting argument that, listen, like, we don't actually make the shoes. We hire third-party manufacturers, contract manufacturers outside of the United States primarily to make the shoes. We'll design them, we'll test them, we provide feedback on them, but we don't make them. But nevertheless, Massachusetts called them a manufacturer. Professor Pomp, what do you think about that?
I think a contract manufacturer can be analogized to an agent of yours. So an agent of yours is manufacturing, you're manufacturing. And then we look to the definition of manufacturing. But manufacturing, it's such a strange concept in many ways. I dry grapes and make raisins. Am I manufacturing? I take big stones and make small stones in a quarry. Manufacturing, our case in Connecticut, we grow actually tobacco in Connecticut. This surprises my friends from the South, for the wrapper of cigars. And we're very famous for doing this. And the way you manufacture the wrapper is you dry it out. You put it under a canvas awning and let the wind dry it out. Is that manufacturing? And we have another absurd case that said, well, you take raw sewage and you convert it into drinkable water, and that's not really manufacturing. No, really? So,
Well,
so all these
What do you
concepts.
think about, should it matter for an apportionment formula? Is this kind of a silly discussion to be having as to which apportionment formula applies?
Yes, it is silly.
Well, that's the bad policy. This case felt to me like the analog being, when I was reading this, it's like, okay, what's the amount of involvement Skechers had? And this feels like sort of an employee versus independent contractor analysis. How much freedom does the individual have if you're telling them what to do, how to do it to some nth degree? Then we're basically going to say the person's an employee. Massachusetts here, I think, said the same thing. Hey, you're really involved in this process. You have people on site. You get to make judgments about when to rerun stuff, et cetera. There was just a ton of involvement from Skechers over the contract manufacturer, so much so that they said, you know what, we're just going to treat you like you own it. An agent, but we're going to treat you like you own it.
Absolutely. A contract manufacturer, you think they have discretion? They go, oh, this is a nice design. We could do it better here in Vietnam. So we think you got a bad choice of colors or whatnot. Of course not. They got completely detailed instructions of what to do. To me, that crosses the line into the employee side.
I wonder if the facts were the other way and it would have benefited Skechers to be a manufacturer. I wonder how that case would have gone, but we'll save that for another day. We'll see how that case goes up on appeal. I bet it will. I can't talk, I'm going to skip this because we're running out of time. Smithfield, I can't talk about, Professor Pomp, but you wanted to talk a little bit about
I will. This may be the most important case since Wayfair. And it's well worth spending some time talking about it. It's kind of Moorman 2. You ask yourself, well, Moorman, when the case came out, 77? 78. Case comes out in 78, endorses a single-factor sales formula. Where's been the litigation since 1978? Has it been settled? Yes, because we've settled some cases. When you think about it, how can a single sales factor disregarding labor and capital give you a reasonable approximation of the business activities in a state? It can't. So why haven't we seen more litigation? Well, you need kind of a perfect storm, and that perfect storm existed in Smithfield. You need a taxpayer with large amounts of value added taking place outside the taxing state. And you had that in Smithfield. I learned a lot under Jeff's tutelage and the fact witnesses about the raising of hogs. I mean, this is science, man. This is not just get them fat and kill them. There's a lot of science in this. The nutrition, they have PhDs working on the proper balance of nutrition. How many do you want to isolate from the others in case of disease? It doesn't sweep through the entire herd, et cetera, et cetera. Each step in this very elaborate process takes place outside of California. Enormous value added outside of California. Very little occurs in California. That's what you need. You could think of income-generating activities as falling on a continuum. Very low value-added activities, very high value-added activities. Smithfield had very high value-added activities. Okay, that's number one. Number two, you need some good fact witnesses who can tell the story. And those existed in the case of Smithfield. Number three, you need a taxpayer with a backbone and a sense of outrage and a deep pocket. And that existed. And then you need the very best state tax litigator in the country to deal with this. And fourth or fifth, you need a good judge. And I think we have a good judge. You know, it gets me so upset. Oh, because of the Tax Injunction Act, we can't get these cases into federal court, and we should amend the Tax Injunction Act. And you know, what is wrong with litigating in the state courts? Some of the finest judges in the country I've ever appeared before are in the state courts. I've appeared before some less good judges in the federal courts. Not that often. It is hard to get into the federal courts. But they didn't know anything about Commerce Clause, due process. They don't do that for a living. Steep learning curve in educating them. Lots of great cases have been won in the state courts, so I much prefer it. We have, I think, a very good judge in this case. Pays attention, understands things, and I am optimistic. Is it over? Is the trial over? It's gone on for a while, I know.
It's in briefing now.
In briefing.
Yeah, we'll see.
All right.
I'm not going to say anything about the case, but I will say this. What is the purpose? It brings me back to one of our initial questions. What is the purpose of an apportionment formula? And I contend that we know what that is, and I contend that it's in the state statute. It's also in UDIPA. If you're looking at UDIPA, it's Section 18. If you're looking at California, it's Section 25137. And it tells us that an apportionment formula is intended to fairly represent the taxpayer's in-state business activities. And what happens if you have no in-state business activities, but you have customers in the state? And that's what we're going to find out here. What do you guys think?
I think you should win, because I've been of the view that, you know,
No further questions.
Where's Smithfield? Virginia?
Virginia.
Yeah, you know, their consumption of Virginia resources and activities is significant, you know, a gajillion times more, any headquartered company, than California, because sales only. So it maybe, you know, there's no perfect way to do this, but it would seem you're always going to have ambiguity, but it would seem that these kinds of cases represent a distortion. Getting back to what is it?
Thanks, Tom. Commissioner Huddleston.
Rick, notwithstanding your discussion of this, I'd like to ask you, in a state that has statutorily adopted single sales factor
Yes.
as fair representation,
Yes.
what role then does Section 18 play given statutory construction of later in time?
I contend, Joe, that when you're looking at Section 18, so Section 18, sorry for the inside baseball references here. Section 18 in UDIPA is the alternative apportionment statute. It basically is the relief valve. If the standard statutory apportionment formula does not fairly represent the taxpayer's in-state business activities, you can use another method.
But
And-
subsequent to your state adopting a Section 18 provision,
Yeah.
you adopt a provision which basically says fair representation is sales only. What happens then?
I think Section 18 applies, this is my view, Section 18 applies, alternative apportionment applies irrespective of whatever the standard formula is. It could be a 3-factor formula. California is a great example. California was 3-factor. It later became 4-factor, double weighting sales. Ultimately, it became single sales factor, which is what it is today. All along, Section 18 has always been on the books. It's never changed. Its job has always been the same, which is to evaluate the standard statutory formula, whatever that may be. It's changed, whatever it may be. And we, as taxpayers, have an obligation, a burden, to show that the standard statutory formula does not fairly represent the in-state business activities if you're looking for Section 18 relief. That's my view, Joe.
No,
Yeah, the
I
state's-
agree with you, actually, but I guess we're going to have to find out, with all the confusion around Section 18, when and where it applies, because we just don't have a court decision
Question.
that describes that to us.
I would say a state can't preempt alternative apportionment or the U.S. Constitution by adopting something. So,
Whole logic isn't, any other questions? Oh, we do have another question. Oh, we have a couple, okay. Oh, we'll come back to you? You go there. All right, thank you, you got it, Drew? It'd be like my co-correspondent here, thanks, all right.
So getting with Section 18
Yeah.
and when it should be used and all that, going back to the FJ management case, right? The Department of Revenue brought up that the taxpayer did not argue Section 18 and therefore was preempted, but the court said, well, you can't bring that up now. You should have brought it up. But my question is, why is that relevant? Because we're not getting to an alternative apportionment. The apportionment should be that it was non-unitary and therefore it's non-business.
Yeah, the discussion, I don't know if you want to dive in on this too. There was a pretty heavy legal debate on Section 18, what we'll call Section 18 in the Virginia case. And one of the arguments was a procedural one, in fact, that the taxpayer had an obligation to raise the alternative apportionment issue as part of a process, and that the department didn't challenge that method of raising the Section 18 issue at the lower court, and they couldn't raise it for the first time on appeal, which was an interesting legal debate that they had regarding what your burden is down at trial versus raising it down up on appeal. So you had that going on as well. Rick, did you want in on this? I know you have an interest in this
no,
case.
ultimately it was irrelevant, though.
Ultimately, it was irrelevant.
So you're quite right. Ultimately, they weren't apportioning anything, so.
Yeah,
Yeah.
the Virginia Supreme Court, by the way, when they denied review, did something that most Supreme Courts don't do, which is they denied review saying that they're okay with the lower decision. Sometimes Supreme Court just deny review, you don't know why.
Right.
Here they said, we're not looking at this case because we're okay with the lower court decision, which I thought also was interesting. Get Bill.
Yeah, Professor Pomp, I want to ask you a leading question because I know what your answer is going to be. So here's what typically happens, and he'll agree with me at the end of the day. In your Colorado thing, you had one state would say it's allocated to Colorado, which would be Colorado. Yeah. And then the other 49 states would say, oh, no, you can't allocate it to Colorado. The people who are buying it, or in my state, you got to allocate it here. So when they exercise Section 18 to provide some allocation to a state where you absolutely have nothing in the state other than a customer, they're creating a distortion by doing so. Why is that okay? So it will be more than the 167, 250, whichever matrix you want to use, the railroad or Hans Reese.
Because I don't think it matters what other states do. You're looking at just what this state does.
No, I'm being
I
facetious
understood,
by saying
yeah.
all the states. Whatever state, that when they make the Section 18 adjustment,
Yeah.
they create a tax, a percentage that's going to be greater than 167 or more than 250%.
Yeah.
And they don't care that they're doing that. So that's what my question to you is that.
All right. That I thought I answered, but I still understand the question. But when they make the adjustment, it should be under that state's approach, and what other states do, not relevant. There's no obligation to make a uniform decision. No, you're just dealing with it. Well, it doesn't create distortion in that state. You're saying it creates national distortion. It doesn't create distortion in that state, so.
Whole logic
Logic.
is a case you were involved in?
What's
Professor
that?
Pomp?
Yeah.
Yeah.
I was involved in this one. Wonderful judge, another example of a very good, smart state judge. The issue was combined report. The parent had a capital loss carryback. When it went to carry it back, it turns out that the entity that created that capital loss did not have any gains to offset the capital loss against. But other members of the combined group did have capital gains. And Hologic said, well, fine, we're going to offset that capital loss against these capital gains. Perfectly sensible in a combined report. The tax department wanted to silo it. This is the real significance when it comes to credits. They wanted to silo it. Oh, no, no, you can use it only against the entity that created it. Well, that's inconsistent with the theory of New Hampshire that you have one taxpayer in front of you, and it shouldn't matter. You know, it all gets blended together. That's the whole idea of a combined report. The judge got it, and
Very good decision.
a very good decision on appeal, though.
Yeah.
I can't believe they're appealing. And this is in many unitary states, this kind of shenanigans
Yeah.
happens with cap losses, with credits, tax attributes. They try to silo it because they know it's to their benefit that, hey, if I put it in a silo, your ability to use it is either nil or, you know, stretched out over multiple
Yeah.
years.
The shenanigans, to give that a little bit of definition, the shenanigans we're talking about here, the way I think about it is the state adopts a unitary combined theory that treats a group of corporations as a single, as they put it, one taxpayer, except when it saves the company some money by offsetting income and loss, or in this case, capital loss with income within the same return. And there they say, no, you're going to trap those losses in a member of the company, and we're not going to allow you to offset income and loss. Yeah. That's what I think the shenanigans that was going on
in
here.
California, we're dealing with, they're saying disregarded entities have to be looked at individually with regard to your ability to assign credits.
Trapping them.
And trapping them.
Yeah.
They're just that's all they're trying to do.
Yep,
You have the Film Commission granting, here's all these credits, and then you have the FTB basically coming up, struggling to come up with anything they can to basically limit your ability to use them.
Yeah, we see this in
disregarded
California.
This is a disregarded entity.
Right.
California has a very extensive set of trapping rules, is how
Oh,
I
my
would call
goodness,
them.
yes.
That's very
The
frustrating.
mother of trapping.
Yeah. Since we're running out of time, we're not going to talk about the Maryland digital ad tax litigation, guys, but we will talk about taxation of advertising generally. Washington State just expanded their sales tax to include sales tax on advertising, or at least most forms of advertising, not all forms, which I'm sure will be challenged. There'll probably be some interesting Internet Tax Freedom Act arguments being made in Washington State as a result of the law change that I think goes into effect October 1st of this year. But it raises other questions too, not just whether ITFA is violated, but how do you source or cite us for sales tax purposes advertising? So if I'm an advertiser and I'm selling you advertising, so I'm going to call you Anheuser-Busch, and I'm going to be Comcast. And Anheuser-Busch is going to advertise on Comcast. And Comcast is headquartered in Philadelphia, and Anheuser-Busch, let's say, is headquartered in St. Louis. Is the advertising service going to be situs based upon where the customer is located in St. Louis for Comcast advertising purposes? Or is it going to be where Comcast's audience is all throughout the United States? How do you situs advertising, guys?
Yeah.
Well, I'll tell you one thing, and I know we're very short on time. Everybody in this room, when your advertising group, media group, marketing group come and yell, say Comcast or NBC, et cetera, is putting tax on what is this? This is the Washington State thing. I think we're going to get a tsunami of inquiries from marketing departments saying, why is there sales tax? And then the question becomes, what's the effective rate on the sales tax? If it's sourced to the commercial domicile of the advertiser, then I guess Microsoft, that's in Washington State, would pay on 100% of its marketing. I don't think that's going to happen.
No.
Then you're left with, do you
apportion?
I think you have to, or you get into where the digital ad companies, if you're running digital ads, can actually do this by delivery. But advertising is incredibly complex.
Well, I think, Tom, what you're saying is you're going to apportion, but now we can debate about how to apportion.
Oh, my
That's what I
God,
hear
you
say.
have to apportion. I think you have to apportion.
Professor Pomp, do you apportion?
You have to in a world where we normally don't think about apportioning sales
that's exactly
taxes.
right. Yeah.
But Washington's member is Streamlined Sales Tax Project.
Yes.
Yeah.
Right?
Yes.
And so they have rules on multiple points of use
Limited.
and whatnot.
Yeah, but those,
Yeah.
there's a path where those rules would actually end up with, say, the Washington State headquartered companies paying 100%.
Yeah. The governor was asked to veto this. very powerful letter was sent to the governor, and he sort of, went forward. Jeff mentioned the Internet Tax Freedom Act. They did something kind of clever. They purported to have a broad-based tax on
Purported.
on
Well, then, yeah.
offline advertising, then proceeded to exempt most
Yeah,
of it.
you're not allowed to tax just one. So they put in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and then exempted 2 through 9.
Yeah.
It's mostly being born on digital advertising. There's a couple non-digital items in the tax base, and now we're going to have an ITFA fight as to how to apply
Yeah.
that.
And Tom's right, it's just going to sweep the country. Oh, Brian.
Okay, Brian has a point.
I'm going to bring the point back to where Professor Pomp started with, railroads. Do we just, is the suggestion from the panel that you don't tax and add advertising to your tax base because it's so difficult to source? Or are we in the railroad situation where now we just have to figure out how to do it?
Well, the real answer is you don't add it, you don't do this in the first place because it's a business input. And a sales tax should not be taxing business inputs.
So I should note that we have friends from Cost in the room, and we have friends from the MTC in the room, and then we have Brian from the Federation of Tax Administrators in the room. We have a nice balance to
And it would answer all of these questions very easily.
Good.
I'm going to deliberately ignore your question, Brian.
We've shot ourselves in our own foot.
Please ignore it because we're out of time.
Yeah, exactly.
All right, I
right,
think
guys.
we are out of time, Drew.
Yes, we are.
Yeah, I want to thank you guys. This was amazing.